From Vanguard to Charles Schwab to JP Morgan, to me, an ETF is an ETF. Some people do have their loyalty in different companies and will only invest in certain ETFs within that company. Me personally, I take a neutral approach and I really look at the best ETFs that are out there. And in today's video, we're going to be looking at 5 Charles Schwab's ETF that could help you retire in that millionaire status. Now, of course, would you like to retire a millionaire? For a majority of Americans, they're saying $1 million will not even cut it when it comes to retirement, which again is kind of crazy considering the average retirement savings is around $150,000 to $170,000 that they actually have towards retirement. Now, of course, people are saying 1.24 million is the magical number that people want to have in an investment portfolio when it comes to retirement. Now, of course, there can be a bunch of different factors with this, including if you're carrying debt or not carrying debt, what are you going to do to supplement income when you do get into retirement? Which is the reason why we want to get into these 5 high-performing ETFs. With number 1 being the Schwab US Large Cap Equity or ETF. This is one that does not just track the S&P 500. Now, if you know, for my personal portfolio, I have the VOO, which is the Vanguard S&P 500 fund, which tracks the S&P 500. Now, this Charles Schwab US Large Cap, it actually tracks a little differently. It tracks 750 of the largest companies. So this is going above and beyond the actual S&P 500 and including some of those large cap companies that, of course, median cap is around 200 billion. Smallest is around 228 million. So you're talking in this large cap fund, you are only dealing with companies at $228 million or higher in this index itself. Now, this one, the ticker symbol is SCHX, which again is a large cap. Now, when you look at performance, expense ratio 0.03, which is very similar to what we see with those Vanguard funds. But looking at the 5-year return on this is 14.5%. So that is massive. When you think of 5% CD rates, the high yield savings rates, if you had your money invested in the market, 14.5% is the 5-year average return for this. And then you even get out to the 10-year, 12.5%. That is right, guys. You're making 12.5% on this ETF if you would have held it for the last 10 years, which is kind of crazy to think because remember, they usually base it 8%, 10% on the S&P 500. The large cap is pointing at 12.5%, which is huge. Number 2, we have the Schwab US Large Cap Growth ETF. So that is the difference. This is focused on growth companies. When you look at the first ETF, there are 750 companies in there. This one holds 248, which are deemed by the S&P 500 to be the growth stocks. Now, of course, this comes with a very heavy focus in the technology industry because that is what is growing. Now, this one, of course, when it comes to the expense ratio, 0.04. So again, very similar to what we see for those Vanguard funds. But over the last 5 years, this returned a 19.3% return in 5 years. That is right. That is the average. You are just south of 20% for return over the last 5 years. Then you look at your 10-year, 15.7% return over a 10-year time frame. Again, you're 3xing what would be, and again, those high yield savings accounts or those CDs accounts if you're trying to keep the money sidelined, if you're trying to keep it safe, when you're looking at the US dividend or the US large cap growth ETF. Now, the ticker symbol for this is SCHG, which is again the Schwab US large cap growth ETF, yielding a 15.7% for a 10-year return. Now, number 3 is the Schwab US Dividend Equity ETF. That is right. One of my absolute favorites that I recommend you buy, the SCHD. This is one, of course, when you look at the Dow Jones US Index, the Dividend 100 Index, this is one of the best ones when it comes to high yield dividend. And of course, we know they just had a rebalancing of this, but this is a very strong paying dividend ETF that is really growing with the income. And again, looking at the return of this one, expense ratio a little bit higher, 0.06, but on a 5-year average return, not only are you seeing a big growth factor of this, 5-year average return was 12.2%, guys. That's right, still yielding well over 10%. On the 10-year return, you're at 11.3% on a 10-year return for a dividend paying ETF. Now, of course, this is kind of subjective because what will happen is if we have a market downturn like we had in 2022, if you see this for a couple of consecutive years, chances are your dividend equity ETFs will stay with a lot more stability. They won't have quite the up and down. We're not going to see, a 20, 30% growth in a year with some of the dividend ETFs, because instead of growing the companies as fast as possible, these companies, these dividend companies, are giving dividends back to the shareholders versus reinvesting back into the company. Now, looking at number 4, we have the Schwab US REIT ETF. That is right, guys. A lot of people are really focused on real estate trusts, which are those REITs. These are companies that own a lot of properties and earn income by renting them out. Now, of course, you have to be really cautious about this, because when it comes to the REITs, you can have, depending on what it's invested in, if it's personal property, if it's industrial property, if it is a commercial property, you can have a lot of different exposure out there, which some people might not want to be in, where residential, people are always going to need houses. Commercial buildings, with the pandemic and remote work, we're not seeing as much of a driving force for the commercial buildings as much as we are right now for the real estate. But of course, with the evaluation and the appreciation that we see of real estate, it is still a very, very good ETF if you're looking to diversify your income. It's a very solid low fee one to add to the portfolio with some exposure to that real estate market. But this is really for diversification, or if you think real estate is going to be really booming in the next couple months. Now, overall, the expense ratio on this goes to 0.07, so a little bit higher than normal ones. 5-year return is a 1.2, 10-year return is a 4.7. So again, thinking of kind of on par with the 5-year CDs, or even looking at high yield savings accounts, could be right about on par with where this is performing. And the final one we look at is the international. So this is the Schwab Fundamental International Large Company ETF. So these are companies that offer international diversification. So this is not tied to just the US market. This is giving you exposure to everyone. But when you think of some of the names, you hear them and you know exactly who they are. So thinking of Shell, which is in the United Kingdom, Toyota in Japan, Samsung South Korea, Total Energies in France, even looking at a couple different indexes, this has 922 companies included in it. But again, this could be an investment where, if the US markets are not doing as well as the global markets, could be really sticking to a good plan to have this as a little bit of the portfolio, just kind of based on the build and based on the growth pattern. Now, looking at this one, the ticker symbol on this one is FNDF, but the expense ratio on this 0.25. So again, considerably higher. 7-year return is a 7.7% on a 5-year return. The 10-year goes down to 4.7%, which of course the US markets have been a lot stronger than we've seen internationally, driving this down a little bit. Now, of course, if you're putting money into this in a regular basis, you have to start investing in your future. Picking an ETF is a very, very solid way to do it. I wouldn't pick individual stocks. They are very volatile. They can be really subjective to the news or social media. A lot of different things can drive down price stocks, even though you're looking at it. So even if in an ETF where you're owning 750 companies, where you're owning 248 different stocks, makes a big difference when it comes to the diversification that you're going to see in your portfolio. And again, if some of the companies perform exceptionally well, great. Some of the companies underperform, they can be replaced in the portfolio, or they can be balanced with the risk mitigation of investing in these ETFs. All right, guys, that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.